Welcome to A Wealthy Life. This podcast is now going to take a step change. We've been talking a lot over the last 50 episodes about mindset and about financial control, really preparing you, laying the foundations to move forward into this series, which is really going to focus on investments and very specifically about property, why I think property is a great idea, and why I think you should invest in property as a foundation to any of the investments that you're going to do to help you create the wealthy life you want to live in. So, as with anything I mention, I'm not giving you advice, I'm just sharing my experience. And in these coming episodes, specifically as we're going to be talking about investment types, I need to start with a caveat, and that is it's important to keep in mind that any form of investment involves risk, and any past performance doesn't guarantee or predict future results. So that's sort of broadly standard along everywhere, although we will all go back and use past performance as evidence and a predictor of the future performance, even though technically that's not something that you can rely on. So you've got to understand your investment goals, your tolerance for risk. And basically what I mean by that is how much can you afford to lose? That's sort of really an indicator. If you can't afford, for example, to run the risk of spending £10 on a lottery ticket because you might not win, then don't buy the lottery ticket. If you can't afford to put 50,000 into a property investment because you can't afford to be without that money, you can't take that risk, then don't do it. It's not right for you at that time. Once you understand your investment goals and your tolerance for risk, then you can start developing an investment strategy. And that's exactly what I do with my clients. We start off primarily having a conversation about what sort of life do you want to live? What are you living now? What would you like to live? Where's the gap? And how can we bridge that gap with the resources that you've got? And so once we've created that general wealthy life strategy, how to get you from where you are now to really where you want to be, then for some people, property is a very specific technique that they're interested in using. And then we can go on and create a property investment strategy. And from that, if appropriate, I can help invest in UK property. So you know that in doing this, you're on a journey that is about long-term strategies, that is going to encompass risk. Some of those risks will be easier to mitigate, and we'll talk about that. But what I'm going to do right now in the first two episodes moving forward, episode 51, which is this, and episode 52, I'm going to talk about smart investing, understanding the right investment opportunities for you and for a wealthy life. And what I'm going to do, it's so big a topic that we're going to do it as an overview, break it down over the two episodes. And then at the end of this, I'm going to start explaining how property is an investment opportunity that you can start out with, because it gives you that opportunity to leverage your assets first and then take the income that you don't really need right now that is generated by your property investments and re-leverage those with other forms of investment, which allows you to then have your diversification. But that's now got very complex. So let's bring it right the way down and just go through, the 5 or 6 investment types generally that there are, and look at some of their pros and cons. So let's start with stocks. So stocks are where a company needs to raise money. It has a number of ways it can raise money. It can go to the bank, and when it goes to the bank, it borrows money, and then it has to pay interest on that debt. And a lot of businesses do that. But another way that it can do is it can sell a little bit of itself to somebody else. And in giving you 1% of a company, you then get 1% of its profits at the other end. You very rarely will buy 1%. You'll buy, a fraction of something when you buy these shares. So stocks involve buying shares in the ownership of the company. You effectively become a part owner of the company. And typically, the main shareholders will keep 51% because that is the dominating control. So you will buy some of the other 49% of the shares. And what happens is you, at the end of the year, typically, or whenever they give their dividends, sometimes they'll give them more often, is you will get something called a dividend. And a dividend is a portion of the money made by the company in that period, and it is shared out amongst the shareholders. But what you can also do is hold a share in the way that is about capital appreciation as much as it is about income. So some of it is lumps of income that come forward. Some of it is the fact that the value of a stock or a share can go up in price. And if that happens, then you may choose to sell that share and gain that capital appreciation. So an example in property terms is your dividend is like getting your rental income once a year if you've made a profit on your rental income, and your capital appreciation is that you sell the house and you make a profit if the house has gone up in price. But of course, whenever you sell and you gain on your capital appreciation, you lose that asset and you lose all future income. So the pros of investing in stocks is that you've got the potential for high returns. I suppose you could say that actually, have you not got the potential for high returns in all sorts of things? But here there is an element of the gamble, in that you are gambling that the stock that you buy will increase in value or give better dividends than anything else that you invest in. I've mentioned diversification right at the beginning, and actually you can have a diverse portfolio of your stocks and shares, as well as using stocks as a way to generally diversify in your investment portfolio. Stocks and shares, I suppose, are much easier to buy than, for example, a property. There's a lot less involved. And so if you wanted to access your funds, and providing that the shares had increased in value, you could sell your shares and withdraw your capital in a way that was a lot easier probably than other investment forms. And of course, I've already mentioned that you're going to have dividends, which is not only where you've got the capital appreciation, but you've got money paid out in often quarterly or annual payments. But the risk here is that stocks and shares, and you'll see it if you ever look at the numbers on the news, they go up and down on a regular basis, and they are quite volatile and vulnerable. So generally, the stock market is vulnerable to economic changes. So, for example, we've seen the war between Russia and Ukraine, or the war of Russia on Ukraine, and that sort of affected everybody, even if the company had nothing to do with the war, because the mood changed, and so therefore people's desire to buy and sell shares changed. And this is where you've got all the guys down there in the trading pit waving their hands around frantically. But you can also have this volatility on a company by company basis. So, for example, if there is some bad press about the impact of the production of petrol on climate, for example, that could suddenly turn people off wanting to buy BP and Esso and all of those other shares. So you might then notice a drop in shares there. Every year, companies have to produce their accounts, and they have this forecasting, and they announce that what they think their accounts are going to be at the end of the year, and then they release those accounts. Well, if there's a difference between what they predicted and what actually came back from the accountants, then that can affect share value. So you can have it on an individual basis, or you can have it across the whole market. So that's the difference between general volatility in the stock market and company-specific volatility. So you could, as I say, invest in one company and it might even perform badly. It's not so much about the stock price going up and down. It may just perform badly, and those shares could plummet and not recover. So an example is Marks and Spencer's were always in the UK considered a sort of a blue chip style of stock to invest in. They were doing very well. And then in recent years, their value has dropped. Now, I don't watch the stock market a lot, and that's just a generalization. So you need to look at that. And then the big thing I think about stocks and shares is that it's somehow secretive. In you've even heard the term insider trading. So once knowledge about a company becomes general, oh, look, company ABC is doing really well, or company ABC is about to buy company XYZ, then everybody knows that there is a potential to make money on those shares. So people will go and buy those shares. So once the knowledge is out there, it's almost like it's a race to get to the shares before the shares increase beyond the amount that you want to pay for them. But there will be people who understand what's going on. So they are maybe already investors, or maybe they are people within the company, or they might be just people that observe the markets and can predict trends. And so they get the information ahead of you, the general public. I suppose this is why we have fund managers. So that's the last thing to say, is that with stocks, you can do it yourself. You can get in touch, you can buy your stocks and shares, but frequently these are done via well, I for example have used a company called Fidelity. So that's a company that you can then tap into and use their expertise and their system to sort of buy your stocks and shares. So let's move on to just another form there. Now, this is completely different for a minute. Now, we are not so much talking about buying a percentage of the company, in a sense, through buying a share of the company. These are called bonds. And a bond is basically an IOU. So it's not just an IOU that says, hi, listener, will you lend me £100? Here is my bond that says you have given me £100 and I promise to pay it back, which in a sense was what money was in the old days. This is where a bond is, yes, I owe you £100, but I'm also going to pay you a set amount of interest on this. Now, these can be raised by companies, but they're also raised by governments. And so you'll hear a lot about the American government or the British government releasing bonds, that there is a bond issue going out. Now, an advantage to these over the stock market is that they're a lot less volatile. So it's not so much on the whims and the performances of individual companies. So this can be something that is a good balance in your wider investment portfolio, because it's not going to do the peaks and troughs of potentially of shares. It's going to be a very nice, gentle movement in the value of this. It's a predictable income, because a bond offers a fixed income for you, paid at regular incomes, whereas the dividend from the share, while it might be predicted that it's going to come out either quarterly or annual, you don't know how much it is. And so you've also got this idea that while you've got safety, if you like, and less volatility, if you like, that's also going to bring you back lower returns in some sense, because the one thing about investment is the greater the potential reward, usually the higher risk and usually the higher volatility. And so you want to have some shares or some investments that might give you that opportunity to make a lot more money, but you also need to first balance that with your attitude towards risk, and can you afford to lose that money if it doesn't work, but then also to put something more stable in there. So an advantage, if you like, of this is that you'll get your lower returns. You might also need to look at the interest rate. So a bond is offered with a very specific interest rate. And this is where it gets complicated, and I'm not going to go into it. But basically, if the interest rate out there in the general money markets, so for example, the Bank of England base rate or the American base rate or the German base rate is different or changes above or below the interest rate on your bond, that can affect, in a sense, the value and the desirability of the bond. If you're not, well, even if you are buying into countries, government invested bonds, as opposed to companies, you need to look at the risk of that country going bankrupt, I suppose you can say. If the country doesn't perform well and then isn't able to meet its commitments, not only to its general loans that it has taken out, but also to its bonds. And remember, the bond is made up of the principal debt it has to pay you back plus the interest it promised. You could actually see that there can be defaults on these payments. So it's not completely without risk. Okay. And so the key difference, I think, here is when you buy a share, you are technically buying a bit of the company, which may or may not do well. But when you buy a bond, you're not buying a part of the country or buying a part of the corporate organization that's released the bond. You are simply lending it money on the basis that it promises to repay you. So it's different. A share is actually a piece of the company. A bond is simply, I've lent you money and this is the debt certificate. You're saying to me that you're going to pay me back my capital and my interest. Now, before I go on to mutual funds, which is where we start getting complicated, let me just talk about commodities. So commodities, I would say, is like the third style of a simple thing that you can invest in. So you can invest in a share, you can invest in a bond. Now you can invest in a commodity, and a commodity is a thing more. It's a tangible investment. So a share is a piece of a company, but you could never really pick up the piece of that company, see the piece of that company, walk away with it. When you've lent the money on your bond, you can't really see anything. Well, yes, you might get a bond certificate or a share certificate, but they're not, they're just pieces of paper. With a commodity, you're actually buying something like precious metals, so gold, silver. You could be buying diamonds, you could be buying oil, you could be buying corn, wine, all sorts of things. So there's a wide variety of markets here that can be traded in. Now, I would say that this actually requires a whole new level of understanding. So on the one hand, if you invest in a company through a share or through a bond, what you can do is you can take out their previous year's accounts and reports, and you can read those if you understand that, and you can make a decision about, actually, this company is well managed, it's making good decisions, it's got good growth plans. You can see all of that in the reports. When you're making a decision about, I don't know, investing in gold or corn or oil, you have to understand the global demands for that product, the global production of that product, the balances and imbalances between countries, and therefore the potential for trading backwards and forwards. Now, commodities, again, it helps you diversify your portfolio, and any form of diversification, some believe, is a reduction in the overall risk. And the values of commodities tend to work independently of stocks or bonds. So it could be affected by inflation. It could be that a new use, let's just imagine that corn suddenly became an integral product in the production of a widely desirable medicine. Then the demand on corn would be over and above making just bread. And all of a sudden, the rest of the world and the rest of all the factors in the world, so stock market stable, bonds are stable, debts and stable, loans are stable, everything is stable. But suddenly the price of corn could rocket because there's been a new use for it. Or maybe they can make fuel out of corn, something like that. So you need to understand that it is a completely different, if you like, world of investment that you're looking into. It is tangible. It can be a good way to hedge your bets against inflation because it won't necessarily be relating to inflation. But if inflation goes up, then the chances are that many of the commodities will have gone up. But you have a whole new level of volatility in the commodity market. And this is affected by, let's stick to corn, for example. What if there's a bad weather situation, or we've just had the whole geopolitical impact of the Russian war, and who knew that the Ukraine was the bread basket, the grain producer for the majority of the planet by the sound of it, and all this grain has been stuck in the Ukraine with no idea of how it's getting out. Imagine what that's been doing to the prices. And so what can happen is you can get short-term losses, you could get long-term losses, so you've got that volatility built in there. The other thing is, unlike stocks and bonds, it's technically harder to trade these things. It's not so easy to just turn this back into cash and make it liquid again. You've got to understand the complexity of this, and you've got to understand the specifics of your product. Because for example, if we take things that are a bit more everyday, so maybe gold and maybe wine, because it's unlikely that you would get a ton of grain shipped home and keep it there. But you could, for example, look at grain or wine. So I have a client who invests in wine, and what he's had to do is create a whole sunken wine cellar thing in the garden that is temperature controlled and all of that sort of level of complexity. Is that really what you want in your investment portfolio? Even if you bought gold, which theoretically could be in smaller portions, and let's say you could walk around and wear it, so you've got some gold rings, gold bracelet, and a gold necklace, do you want to be going out with all of your value and all of your wealth on your body? No. So then how are you going to store it at home? Then you're going to have to start to look at safes. And alongside this, although I don't think it technically comes under the commodity heading, is that people can invest in things like vintage cars, in art. So I know, again, from a previous client contact, that when they bought a vintage car, like wine, it has to be stored in special conditions because you can't have high humidity or it'll go rusty. You need to have security. So it's got to be temperature and humidity controlled. Artwork has to be very carefully protected from humidity, from sunlight. So you can't just stick it on your wall because the sunlight that naturally would come in your window could be fading it. So you've really got to look at a much more complex, whole business. It is a business model. I mean, I think all investment is a business model, right? So this is a whole new level of business understanding. You're either understanding the business of how the company whose shares you want to buy is running. You need to understand the business of the country, how the country is being managed and performed if you're going to take up bonds that are issued by a government. If you're going to get into specific commodities, you understand the commodity market, the trading of it, the uses of it, the risks to it. So it's a whole business going on here. And so there are a couple of ways, and I'll talk about some more of them next week. There are a couple of ways where you can almost mitigate some of the risk. And this is by grouping things together. And they're often used, the term is used as funds. So I'm going to talk to you this week about something called mutual funds. But then what we'll do next week is we'll go on to something called exchange traded funds, EFTs. So a mutual fund is something that you would most likely buy through a fund manager. So mutual fund is more of an American term. I actually think it's an easier phrase because in the UK we call it an open-ended investment company, so an OEIC, and they're basically the same thing. So I'm just going to use the word mutual funds because it's easier. And what this is it's a portfolio of investment securities. So what you're doing here is you're not just putting all your shares in Marks and Spencer's or BP or Coin corn or gold or that type of stuff, or a bond in the UK or a bond from Germany, what you're doing now is, instead of buying, imagine going to the supermarket and buying just one thing off the shelves, so baked beans. Now what you're doing is you're picking up a bag that contains a variety of foodstuffs. So your baked beans, maybe some fresh apples, maybe some meat. So there's a whole mix in there. And that effectively is what a mutual fund is, or any of these funds. They are a collection of securities designed to offer the investor different types of investment, levels of risk and levels of return. So sometimes what you can do with funds is you can look at funds that are low risk. So they will be a low risk fund and they will give you a lower level of return. But because they've got lower risk, you can feel more confident in them. Or you might find some that are green or some that are higher risk. And so you've got to look at what your appetite is. As with all of this, right? When I said, what is the reason for wanting to invest in something? And for me, that's always going to be because you want to improve your life for the better. You are prepared to take control of your personal finances rather than just relying passively on a wage coming into your bank account and then the bills going out and you hoping that there is a surplus at the end. What you're actively doing is saying, I'm going to take a section of my income and I am going to look to leverage that. Now, the leveraging that you do through shares, through bonds, through any form of funds, and next week when I talk about EFTs and crypto, that isn't leveraging quite the same way that we will talk about it with property. And I'm just going to cover that briefly and I'll tell you about it again. You're simply going to put your money into some other asset form and you are hoping that the form that you invest in works and leverages your money, uses your money in that environment to make more money for you. So it feels a bit like a passive form of leveraging. I'm going to give you, the share issuer in this company, some of my money by buying a share off of you, or this government by buying a bond off of you. And I want you to use that money wisely so that when you give me back my dividends or you pay me back my interest or anything else, that not only the value of the thing that I bought, the share, the bond, the fund increased. So I've got the capital appreciation, but my dividends and my returns are higher because you've performed well. If you think about property, some of that is simpler. Okay, so I'm going to buy a house. So say you do a cash purchase of a house. I'm going to buy a house. I want that house to increase in value. There's my capital appreciation. And I want the tenants to pay me rent. And I want that rent to give me back more money than if I've just left my money in the bank account. But what you can do is you can leverage that leverage again. So now we're not just relying on the house performing, the company performing, the share performing. You can leverage it again, and you can leverage it in two ways. You leverage it first by, instead of putting the whole £100,000 into a house, you get a bank to join you in this investment. And yes, you pay the bank interest when you borrow money on this mortgage, you pay them interest. But if you know that the return that you're going to get on the property is going to be more than the interest that you pay the company, why not borrow some money from the bank, invest the money in the house? Now you're investing less of the money than you would have before because you're only having to put down 25% deposit and then, yes, the buy costs. But that leaves more money in your pocket so that maybe you could buy 2 properties or 3 properties for the same amount of money that you could buy one, because you have now leveraged your money by taking out a bank mortgage. So that's, for me, a leverage on a leverage, which you're not going to get with stocks, shares or anything else, because banks won't lend you money to buy those if they knew that that's what the loan was for. So, you know, if you do anything else, that's up to you, but they will not directly lend you money. Oh, hi bank, I'd like to take out a mortgage on some shares. Okay, in simplest terms. there are many complex things here, but keeping it simple. The other way that you can leverage your property investment is that instead of just getting your money from your tenant and being in a position where you collect the rent, you can save your time and you can make a letting agent collect the money for you. Yes, you're going to pay them a fee. Let's just broadly say it's 10%. But 10% of your monthly rent is a small amount of money, even if you're investing in HMOs or city centre flats that are going to get you a couple of grand. Even if you're getting in, say, 2 grand in rent on a city style apartment, and you're paying 200 out in management fees, your time is worth more than going around there to replace the light bulb, to fix the dripping tap, or to deal with anything else. That's what you're paying the agent for. And if the whole purpose of this is to create a wealthy life for yourself, then what you want to be doing is making sure that you leverage as much as possible. So in classic Vicky style, I wandered off down a property conversation there when I was supposed to just be talking to you about mutual funds. So just to sort of give you a hint of some of the names associated with mutual funds, it's like Scottish Mortgage Investment Trust, or BlackRock World Mining, or Fidelity's China Special Situations Fund. So the mutual fund is a collection of entities that you can then invest in, rather than you having to go, I'll buy some shares here, some commodities there, a bit of a bond there. So it's doing it for you. But of course, there are going to be fees. As with all of these things, when you start bringing somebody else in, there are fees. And so you need to understand the fees that are involved. So flying through, we have looked at what shares are. They are buying a portion of a company. We've looked at what a bond is. That's lending money to a company, or more often to a country. We've looked at what a commodity is. That's buying a more tangible product that can be turned into something else. But then we've also just had a quick look at mutual funds as one of the ways that you can start to group some of these things together. As with everything, there is risk. You need to understand your objectives. I think also with some of these things, you need to understand your morals or your values. Do you really want to be investing in the shares of a cigarette company or an oil company, or, I don't know, anybody that behaved in a way that didn't meet your personal values? Maybe in the old days, some clothing manufacturer that was using child labor out in the Far East as a way to produce their clothing range. So understanding the companies that you are getting into and how they match your values, I think, is also an important part, not just the overall strategy. So I'm investing in shares or bonds or funds or commodities because I want to mitigate risk, or I want to have low volatility, or I'm in it for the long term. So I'm looking at, slow but consistent capital growth in this, thing that I have invested in. All of that, you are probably going to require a massive amount of research on your part, or you're going to have to find yourself a trusted financial advisor. And the only thing that I would say here about financial advisors is you need to understand how they make their money, because financial advisors will get a fee. Now, either they'll charge you the fee, or they'll be getting a fee for selling, if you like, the share or the fund or the commodity. So look at how they make their money. Look at if they're whole of market. Look where their expertise is. Are they only able to advise you on shares, or do they understand commodities and EFTs? Do they understand crypto? Possibly not. But, what are they involved in? Where is their expertise? And does that match up with what you want in terms of your bigger picture? So part one of understanding smart investing and understanding how choosing the right option can help you achieve a wealthy life, and a wealthy life quicker than you thought was possible. So look out next week for part 2 of this, where I'll talk to you about EFTs, that'll blow your mind, and crypto, that'll befuddle your mind. And then eventually we'll get on and we'll talk about property, which is much more comfortable. It is both tangible and more recognizable for us, because we pretty much all live in a home of some form or other. So until next week, I thank you very much for your time listening. Please make sure that you like, subscribe, follow. Please leave a review. All of that helps signpost to other podcast listeners as to the value that you've got out of these podcasts and why they should listen. And maybe even share things on Facebook and Instagram and places like that as well. That would be lovely. My name's Vicky O'Shea. You've been listening to A Wealthy Life, and I hope that I have put a little bit more whoosh into your investment understanding.